Welcome back. We've moved on now to assessing options for drought recovery. As promised previously, we've assumed that it has rained. These presentations, there's two of them available on the Future Beef website, and the first one we're now looking at is options for recovery, and then in the final presentation we incorporate climate variability in the analysis to look at how that impacts on response and recovery strategies. So it's rained and we're in this period where we're thinking about recovery from drought. Everything looks a bit better, everything looks a bit brighter, and the steers we retained and didn't sell certainly look pretty good. But we've got to remember the start of each recovery period has different market conditions, pasture quality and quantity, timing. So there's different aspects each time. There's no answers. Again, it's all about what are the questions we've got to answer, and how do we assess them. So the key question is, how do we take best advantage of the changed conditions? Even though each recovery period is different, the same framework can be applied. So the framework is the same all the way through the preparation, the response and the recovery analysis. And we're going to use the same framework to assess the relative merit of these alternative recovery actions. The recovery strategies obviously depend upon the classes of numbers of livestock that you've on the property, the market opportunities either to buy or sell cattle, and the manager's attitude to risk. That's quite a critical aspect that we will take into account when we're looking at these alternative recovery strategies. Now, the available tools that we've been using all the way through these webinars or presentations can be used to assess the impact of the sales strategy during the response to drought on the speed of recovery. Now, we looked at that in the previous presentation, the impact of alternative strategies on cash flow and profit, and the impact on long-term viability and resilience of a decision to maximise returns in the short term. Now, we're going to be looking at aspects of those alternative ways of looking at things, alternative assessment processes in this presentation. So the tools to be applied are either all from the Breed Cow Dynamo software and downloadable from the DAF website, or the spreadsheets that we use in this presentation are available on the Future Beef project page and can be downloaded from there. Let's go back to the end of the previous presentation where we looked at the impact of recovery in numbers over time of those two separate options that we considered. So there was option A of selling the PTE breeders, or option B of selling down the young stock. And remember, we constructed a livestock schedule where we showed the typical numbers of cattle that we would have at the start of the drought, our normal sales pattern, our sales pattern if we sold just PTE breeders out of the herd and left everything else the same, or the alternative option of selling the young stock, cleaning out the young weaner heifers because we didn't need them immediately, cleaning out all the next age group of steers and some young steer weaners to get to the same point in terms of reduction in grazing pressure. Even though there's a lot more young cattle and a lot more cattle here in total sold than selling out the PTE breeders, the main game was to sell out to achieve the same reduction in grazing pressure, which here is seen on our graph that shows adult equivalents and over time, where in the first year when we complete those sales of either the young cattle, of option A, sell the PTEs, or option B, sell the young stock, we get the same level of reduction in grazing pressure. That's the point of that exercise. And we discussed previously that it took a considerable period of time before the property returns to its long-term carrying capacity. So it takes 6 to 8 or 10 years, depending on which strategy you follow, to get back to the number of cattle and the herd structure that is your long-term carrying capacity. the decision to sell down the young stock, which is just option B, including the weaner heifers, does cause a significant lag, this lag here, compared to the decision to sell down the PDE females. Basically because you sell down the females, you do keep your young stock, and then they come through and rebuild the breeder herd quicker. Whereas selling down the young stock means you've got to have more calves, build up the herd, and there's that lag there. Let's have a look at the impact on cash flow and review what we found before. We've got our cumulative cash flow budget over years, and here is our sales strategy in the drought. We end up with basically the same cash in bank from the initial reduction in grazing pressure. But we make the point, the choice made of how many to sell and when will impact the capacity of the property to service commitments. So sell down your PTEs, and then the next year you sell down your normal sale cattle. Okay, the cash at bank goes up, and then it'll sink away as everything readjusts. And sell down your young cattle, and then they're gone, and you've got to wait for the other cattle to come through. Now, the interesting thing about what's happening here is the choice to sell down the PTE breeders provides the same amount of cash, but the retention of the younger females in that strategy to rebuild the breeder herd associated allows the cash balance to be maintained. So the cash balance is maintained a little bit higher there, but both drought sales strategies end up with about the same amount of deficit by year 6 or 7. Now, okay, the question is, do we need to look 7 years ahead with budgeting? That's a long way ahead in budgeting, but it's interesting to note that there are significant differences over time from selling option B, selling down the young stock, and option A, selling the PTE breeders, on cash flow over the long term, based on the difference in those strategies. One rebuilds the numbers and the cash flow much quicker than the other. The point is that neither of these strategies are all that good, because there's a big gap in the potential of the property and what you're doing. So you can't allow that gap to maintain. You've got to fill the gap between the grazing pressure applied and the carrying capacity available. The drought broke there. We're rebuilding our numbers, and there's this gap between what the property will carry and what's on the property for that of quite an extended period of time. So it's apparent that letting the herd slowly rebuild after either of the drought-enforced destocking strategies is likely to impact the viability of the property. And it's necessary to identify strategies that will efficiently fill the gap. So that's what we're going to do here. Now, the strategies that we nominated to efficiently fill that gap. So here's our gap in grazing capacity, our grazing pressure applied. We can fill that gap to get up to our normal numbers from basically from 2019 on. There's 300 or so adult equivalents now. So we identified that those strategies could include the purchase of cows and calves to fill that gap, to rebuild the herd, taking cattle on adjustment, turnover stock, repurchasing the components that you sold, depending on what you sold, or a combination of the above. So that we identified that. Let's now start to look at those strategies. And the first one here, purchase PTIC cows to rebuild the herd. Let's pretend in our budget that, okay, we sold the PTE cows. So the red line is to sell the PTE cows. The blue line is our imaginary no drought. And this green line is, okay, when the drought breaks, we go straight out and we purchase sufficient PTIC cows to rebuild our numbers more quickly, to get us back up to that stocking rate. So there's our cash flow, ducks down as we buy those cows, and then our numbers rebuild, and we decided, okay, the PTIC cows purchased in May, and they produced calves later that year. The number of weaners returned to the normal level in the following year. The cash deficits were increased, so compared to selling the PTE cows and just hanging on and doing nothing, there's a significant difference there in the cash flow. It takes about 7 years to get back to equivalent status, but after that, it does progress better than just the do nothing, let your herd rebuild strategy. Even so, those differences there, that big difference in the net cash flow, your lender, if you've got to go out and borrow money to do that, could see that as a risky strategy and say, hang on a minute, is there another way we can do that? Now, let's look at taking stock on agistment to fill that gap. We assumed that the difference in AE count was available for agistment from 2019 onwards, so the drought broke. Okay, the drought broke. Agistment income will continue to be received in small amounts right out till 2036. So here we are. Our parameter is the years, the amount of room that we can calculate there available for agistment. Of course, it goes on in small numbers after that. And based on about $2 per AE per week, this is the amount of income that we could generate by taking cattle on agistment in each of those years. So it starts off and then it falls away to quite small amounts. Now we add that into our cash flow. So we sell our PTEs and then when the drought breaks, we bring in agistment cattle. You can see the cash flow is quite positive, and it still stays ahead of most of the other strategies. Of course, our own herd starts to rebuild through here and provide cash flow. The agistment cattle disappear, but it sort of is quite an interesting outcome there of using agistment cattle to fill the gap. So the cumulative cash flow looks okay if the spare grazing capacity can be filled by stock on agistment at about $2 per AE per week. Whether this is possible is unknown, but okay, higher or lower rates of income from agistment are easily tested. You just change the value per head per week or per AE per week in the model and it'll recalculate your cash flow. Taking cattle on agistment seems to provide a significant protection, so there's extra cash in the bank there compared to going out and buying the cows. In the early years while the herd is rebuilding. So the cash flow looks a little bit more interesting there. It seems to be a fairly low risk option because you're maintaining your cash flow over time there. Trading cattle, let's think about trading cattle. There's numerous scenarios for trading cattle. You can buy nearly every class of cattle imaginable. We can look at this option of trading cattle in either the bullocks program, which we've looked at previously when we're looking at destocking cattle, or the cow trade program. Now, bullocks program, as we explained previously, is about the purchase of dry stock or the sale of dry stock in a destocking scenario. The cow trade program is all about purchase of cows and calves or PDIC cows. So they're either cows that are going to have calves or that have got calves at foot. They're part of the breed cow dynamic suite of programs. Now, let's go back over what cow trade does. It's used to calculate the future profitability or the prospective profitability of breeder groups. Some of them will produce or already have calves. The bullocks program is for dry cattle, steers or empty cows and heifers. Same sort of process, just you can incorporate cows and calves or PDIC cows in one. The other one is built for dry cattle. So the criteria when buying cattle to fatten or grow out, it's logic, it's about profit. So the options that provide the greatest future benefits are the ones you want to choose. So the profitability criterion for choosing between fattening or growing opportunities is nearly always the predicted gross margin per AE after interest. The way we construct these things is to bring it back when you're comparing either cows and calves or PDIC cows or dry cattle of different classes. We bring it back to the same unit of consumption and we bring it back to a measure of profit, and we take into account the different amounts of capital tied up in the different sorts of cattle that we're trading. But then if finance is tight, it means you haven't got enough capital to stock the available pasture, then the profitability criterion is probably gross margin expressed as a percent of herd and expenses capital. That's probably the more satisfactory way to think about allocating scarce capital resources to buying different classes of cattle, and we'll look at that. So let's have a look at an example of yearling steers, purchasing them in April and holding them for 12 months. So We expect to hold them for 12 months, and because this is still our North Queensland Gulf property, it's rained, but we still only expect them to put on about 140 kilos over the year that we hold them. Our purchase and sale price will both be $2.40 live at the yards. Given there will be costs incurred in getting the steers home, so we've got to go and buy them, bring them back, will this be more profitable than purchasing pregnancy tested in calf cows, holding them for 12 months, letting them calve and selling the cow winner? So this is not about purchasing PDIC cows to build up the herd. This is just, is it better to turn over PDIC cows or is it better to turn over steers? And we use these models to assess that decision. So the spreadsheet is available for download. It's called Trading Yearling Steers as a Recovery Strategy. If I open that spreadsheet up, there it is. It's the same one exactly as we used in our response analysis of whether we should sell steers or not. And it's got the traditional old bullocks gross margin on this sheet here. It's got the notes about bullocks there, and then it's got this yearling steers one, which is the dry cattle trading calculator bullocks that has been modified, a modified bullocks program based on a formatting change that Mick Sullivan organised. So let's use that one because it's a bit easier to follow. We've got this normal sort of linear approach to doing the calculations, and over to this one side over here we've got transport cost calculators and things like that, and we've got tables over here to look at the sensitivity of the results. So let's start at the top. So we can enter data in the yellow cells, recovery trading of yearling export steers. So we're going to buy some yearling Brahman steers. We're going to 100. We could use one as an example because we're going to compare them on the basis of per AE. So we've just nominated 100 of them. We think we're going to go out. It's rained. We're going to buy them early April. We're going to hold them for 12 months, 52 weeks. Now, we're going to have to travel and find these cattle, so we allocated $500 total to that, or $5 a head. To get them back to the property is $25 a head. Here's our calculation over here of how far we've got to bring them and dollars per kilometre and the rate on a per deck. So that gives us our $25 there. It's going to cost us some money to settle them down, get them through the yards. We're going to buy them at 254 kilos average for $2.40. So that gets us a steer landed on the property of $644.60. Net purchase price at $2.54. Although we buy them for $2.40 at the yards, by the time we get them home, they're $2.54. Now, to hold them for 12 months, we're probably going to put some extra health costs into them. Reasonable paddock. We haven't got any supplements or anything in there. Sale weight and price. So over the 12 months, we expect them to put on the 140 kilos, which is 0.38 on average per head per day. Gives us a 400 nearly kilo steer in the paddock at the end of that period. To sell him, we've got to get him to the yard, so he's going to lose a little bit of weight. By the time we sell him in the yard, we expect to have a weight, an average weight at the yard to 374. And as I said, $2.40. Out of that will come some commission, our levies, our yard fees, and the cost of getting them from the property back to the yards to sell them. We can use our transport cost calculator to calculate that. They're slightly heavier steers, so there's less on them per deck. We probably expect over the 12 months some losses. We've nominated 2%, so we buy 100 steers and we sell 98. Now, while we're holding them, we could have had that money in the bank earning interest or saving interest on our debt. So we've nominated 5% as the opportunity cost of our interest. And in that case, we could have earned or saved $3,600. So that's part of the cost of buying these steers, the opportunity cost of the interest. And there's probably a very small amount of opportunity cost on the variable treatment costs that we put into them. We work out our adult equivalent for this animal. As explained previously, Breed Cow Dynamo uses just this proportion of the international standard weight. So for this animal that's got a weight coming in at 254, a weight going out 12 months later of 394, the average weight over the period's 324, we divide that by 455, and that says it's about 0.71 of an adult equivalent. We've discussed that in the previous presentations. Now, our gross margin calculations are here. Gross margin before interest. I've said gross margin after interest is the one we want. And because we've got our adult equivalent calculation in there, we can calculate gross margin per adult equivalent after interest. There it is there, gross margin per AE after interest, and return on investment on livestock costs. So they're the two indicators we're interested in. And if we want to look at how sensitive those are to purchase price and sale price, we can come over here and say, okay, for each, this is 10 cents a kilo, so for each fall of 10 cents a kilo in our sale price, you can see here, gross margin per AE less interest, each 10 cents a kilo fall leads to about a $50 per AE fall in the gross margin, which is quite significant. And then for each 10 cents change in the purchase price, if we were paying $2.54 for them, if we get 10 cents less than that, of course the gross margin per AE improves. If we go 10 cents higher than that, of course the gross margin reduces. So it gives you a bit of an idea of the sensitivity. Let's go back and summarise that. So we decided how many head we're going to have, how long they're going to be there, the costs, the landed price on the property, and then we decided how much weight they're going to put on and what they would be worth at the end of the period. From that, we calculated these indicators like gross margin per beast or gross margin per adult equivalent per year or gross margin per month, but we said no, the one that we can compare with other classes of livestock is the dollars, the gross margin per AE after interest, because we bring them back to a standard grazing pressure for this class of cattle, the dollars per standard grazing pressure, and we take into account the amount of capital, the opportunity cost of the interest tied up in those cattle. And we've also got there our indicator for return on livestock investment. Price sensitivity we discussed in the spreadsheet. A small change in the buying or selling price can really have a dramatic impact. We saw that, so we're assuming values here. We probably know a little bit about the purchase price. We don't know a lot about the sale price in 12 months' time. So if it falls significantly, we don't make a lot of money out of that exercise. So there's what we call price risk. There's the risk of the price changing over that 12-month period. So we've got to think about the price risk. Let's go on and have a look at trading cows and calves, the other option that we could consider. In this scenario, PTIC cows are purchased in May and the cow and weaner sold the following April. So that's our trading. None of the purchased cows or the weaners they produced are retained, they're all sold. The sale weight of the cows and weaners was slightly better than the breeders normally run on the property because in this case we've got a good season and they're running in the steer paddock. So let's have a look at the spreadsheet. It's called Cow Trade by PTIC Cows as Recovery. So we're using the cow trade model. And let's see if we can load it up. Here's our cow trade model. I'll make that a little bit bigger so I can see it. Same old cow trade model developed by Bill Holmes. Very handy little model looking at these short-term scenarios. We've got our summary tables there that we can run with macros. We've got our calculate the value of the owned stock on the farm, calculate the landed cost, and then our net selling calculators, our transport cost calculators. So we've got some boxes over there we can access, but it's basically this vertical arrangement. These are PTIC cows. We're going to buy them on the 1st to the 5th. They're going to calve on the 15th of November. We're going to sell them in 12 months' time, the 30th of April. They're going to be 450 kilos in, 450 kilos out. We're not going to put any weight on them because they're going to produce a weaner. Now, we've got the weight of the progeny at 5 months. The reason we do that is to work out a weighting on the cow for the extra energy she needs to provide that late pregnancy and early lactation stage up to 5 months. Then once they're post 5 months, we rate the grazing pressure applied by the calf post 5 months until it's sold. And then the weight of the progeny at sale, which we said is 170 kilos. Now, the starting value of the group, 950. Where did we get that from? Because we're buying these cattle, we come over here into our calculate the landed cost of purchase stock. So we've got to spend $500 to find them. We're going to buy 100. Doesn't matter how many buy. We could buy one cow and calf unit and get per adult equivalent analysis. We've got $40 to spend on getting them back to the property. We've got an induction cost of settling them down in the yards. And we say we can get this cow and calf, this PDIC cow for $2 a kilo, which makes them 950 landed on the property. So there's the cost of our PDIC cow. 12 months later, when we sell them, calculate the selling cost, that should be down here. We've got a 450 kilo cow. We think in 12 months' time we'll get $2.10 for her. We've got some commission to come out. We've got some transaction levy, and we've got to pay to transport her to the yards. Same thing with the weaner. We're selling that. We think we can get $2.50 for that. We've got commission to come out. We've got some transaction levies and things like that at the yards. We've got a transport cost to allocate to get it to the yards as well, which gives us $852, $383. And we can come over here and put our $852, $383 as our sale values. Again, we've got an opportunity cost of interest because we could have put the money in the bank and reduced our interest cost or earned interest. We expect a 90% weaning rate from these PDIC cows, 10% loss post-conception. Death rate on breeders, we're bringing strange cattle onto the property, could be as high as 5%. A death rate on the progeny, we could lose 2% of our weaners. Our husbandry cost, we're probably going to have to put some supplement and stuff into these cows because they're going to be there for the dry season. A little bit of expense on the weaners. So we then do this calculation of the grazing pressure, relative grazing pressure applied by that cow and calf unit. We rate the breeder. We rate the extra on the breeder for carrying that calf through the late gestation stages, the early lactation, up to 5 months of age. Then there's a little bit of a waiting there for 5 months until that weaner's sold. It's sold very soon after. And then so the total weighting AE equivalent grazing pressure applied by that cow, then calf unit over that 12 months is 1.32. And that allows us to calculate the per AE gross margin. So we've got figures there for total gross margin, for breeder and progeny, for adult equivalent for year. This is the one down here, gross margin per AE per year after interest that we're interested in, and there's our rate of return on livestock capital. We've got our sensitivity tables down the bottom there if you want to look at them. So let's go back and say, okay, the summary. We worked out the weights of our cattle. We worked out the selling values and the costs of holding those cattle, and which indicator. So in that cow trade, we've got the AE, dollars per AE after interest, and that's what we said for our steers. And 20.39 was a return on livestock investment. We use this one if we're short of capital. We use this one if we've got enough capital to support a purchase of all the cattle we can use to stock the paddock. When we looked at the cow trade analysis, there were things in there like total gross margin per unit, to breeder and progeny, gross margin per adult equivalent per year. No, the one that we were interested in is this one, gross margin per AE after interest and return on livestock capital expenses. There's lots of indicators out there, but you've got to compare apples with apples. So these two here can be compared with these two there. And what it basically says, the profitability criterion for choosing between short-term fattening and growing opportunities is nearly always gross margin per AE after interest, because you can fund the purchases. So it's that one compared to that one. And if finance is tight, it's these two. So on that basis, trading the yearling steers looks better on both counts. It's a more efficient way to allocate capital, gives you a better gross margin per AE after interest. That's okay as far as it goes, but you could also adjust that country. So what about, instead of buying cattle, what about taking steers on adjustment on that country? So if we said we could get $2 per AE per week for 50 weeks, that's $100 per AE per annum, which is better than trading PDIC cows, not quite as good as trading steers. But remember, there's price risk in that. And at $3 per AE per week for your adjustment, that's 150, which is up there pretty close to that. So when you're looking at comparing adjustment versus trading, the answer depends on how well the steers do. So we have associated a weight gain, a price change, and whether the buy price and sell price can be adjusted. So if you can buy cheaper than we thought and you can sell dearer, you get a lot better gross margin. Let's have a look at the impact on the cumulative cash flow of our North Queensland Golf example of trading those steers. And you can see it is the sell PDE, where are we? Sell PDE and trade steers. It's the red line. So there's our adjustment line. The green line is our buy the PDE IC cows and rebuild our herd. This is just a trading option. So we keep trading to fill in the gaps. And you can see it's probably better than buying PTIC cows and allowing the herd to rebuild on the basis that we haven't got price risk in there. And it does eventually give you a better cash flow over time as your herd rebuilds than that adjustment. So that's the low risk. This has got more risk associated with it, but it may be more profitable. So with this trading, there's this significant additional interest and other expenses incurred in trading cattle. It's likely to initially reduce the cumulative cash flow. So there you are, the bottom point there is the cumulative cash flow of trade steers, well below the other option of taking cattle on adjustment. Look, there's $400,000 in the bank difference there. The capacity of the property to fund the steer purchases may be a very relevant factor. The steer trading model is more risky. We pointed that out. There's a lot of price risk in there. Now, the economic and financial difference over time between trading steers and purchasing PDIC cows obviously depends upon your assumptions. And we've made very specific assumptions. We haven't done a lot of sensitivity testing, but the assumptions of the purchase price of the cows, the pregnancy rate, the transaction cost, the sale price of the purchase stock, you don't have to change them very much to change the answer. But even so, any of those methods, it still takes a number of years to get ahead of the net cash flow provided by taking stock on adjustment in that short term. So this is a pretty simple analysis, but it's something to think about. Let's summarise our recovery strategy so far. The point was that in these northern herds, the reproduction efficiency of most of these breeding herds identifies that waiting around for the numbers to recover is not a good idea when there's bills to be paid. So you've got to do something. The best way to recover is to restore the profit as soon as possible, and there's options there to do that. But doing something to restore profit as soon as possible might impact the cash at bank position. You might have to go and talk to the bank manager. That could require some significant negotiation skills as you're coming out of a drought and a great deal of hard thinking. Each of these opportunities that we've looked at here, they need to be assessed and taken as they arise during the recovery phase. So our analysis here depended on a set of parameters. Those parameters can change each time you need to look at this opportunity. So they need to be reassessed. At times, trading could be an option. At other times, adjustments could be an option, or purchasing PDIC cows to rebuild the herd could be the best way forward. The recommended strategy is obviously to assess and reassess both the short term and the medium term. Match the number of stock on the property with the available pasture resource, and sometimes there could be risk involved. Sometimes you've got to be prepared to take an additional risk if the right opportunity comes up. Considering the results of this sort of analysis, well, look, there's problems. Considering the results of an analysis based on another property or on this sort of example property is just a way of understanding the key factors of the decision. It's rarely an accurate indicator for what's going to be the outcome for each separate manager or beef property. So there's a very large concern there that you can't see these results and say, oh, well, I'll go that way. No, you've got to do your own sums. So producers or people who advise managers can use the tools and models to do the same thing that we did. We can conduct an analysis, but it's got to be specific to their circumstances. The key insight is that the value of any response or recovery strategy, and we've been through a lot in the last 7 or 8 presentations, they depend upon the circumstances of the manager, the risk they're prepared to take, and the property considering the change. It is necessary to apply the right planning framework. Starting with the wrong planning framework doesn't help. And you've got to reassess the strategy as change occurs. There's no set plan here. Okay, that's that one. We'll go on to number 9, incorporating climate variability, making things a bit more complex next. Thank you.